Welcome to Berman's Call. Larry Berman is here to take your questions on stocks and ETFs today. You can reach him toll free 1-855-326-6266 or email Larry at bermanscall@bnnbloomberg.ca. Larry, great to see you. Give us your thoughts on market volatility. Remind us what you said last week about the overall level of stocks.
Yeah, so in our Pro Eyes series of indicators last week, we looked at them being in the opportunistic zone, suggesting the markets were very oversold and we should start to look for opportunities. And I think I said something like, all it's going to take is one tweet from the president to get a face-ripping rally. And that's what we saw on Wednesday. But the level of volatility is still very elevated, and I think we're in the very early innings of this. You know, it seems one day there's good news, the next day he's leaning against it. There's mixed messages coming out of the White House, and so that level of uncertainty doesn't promote the beginning of a new bull market, right? So I think there's a lot more to go here. I think it's very early, and there's still a degree of caution. So while at 4,800, 4,900, 5,000 on the S&P, there was opportunity, at 5,400, 5,500, 5,600, there isn't, because I don't think we're going to be able to sustain these levels looking out, 3 or 4 or 5 or 6 months.
So you see the market, where would you see the market, or a bottom for the market, Larry?
I think it's going to be at a lower low than what we've already made.
Okay.
But we need to see the economic decay. We need to see the job losses. We need to see what the market's worried about in that this is going to tip us into a recession. If we don't see that, I'm wrong, and we can go higher. But remember, Andy, we started off from a place of extreme valuation relative to history. So it's not like the market got cheap last week. It didn't. It's still very expensive at a 21, 22 multiple. So earnings have to grow phenomenally, which is going to be tough in this environment of uncertainty. We're starting to hear from companies or as earnings period starts here. When you start to hear from the retailers, when you start to hear from the companies that have international business channels, those are the ones that are going to tell us, be conservative. So that's just starting.
We are, of course, getting some earnings. Goldman Sachs, New York Times has an amusing story. Apparently, the Goldman Sachs executives studiously avoided using the word tariff on the call.
And not surprising from that perspective, because you don't want to be in the president's bad books in that sense. But the high activity, the high volume is great for the trading types. So a Goldman Sachs, a Morgan Stanley, the ones that have that business are generally going to do okay in this environment. Goldman announced a $40 billion additional buyback, I believe I heard this morning, but they're not buying it at 54, 5,500. They'll buy it somewhere below 5,000 when they need to, and things get cheaper at some point down the road.
Maybe we can put up a chart for Goldman Sachs. Yeah, I mean, all any executives can do at this stage is say, we're waiting to see.
If I was managing Goldman Sachs, and I'm not, there's my buy zone. They wouldn't be selling their own stock, but this is the sell zone now, because you have this on so many stocks from the post-election rally. We call this overhead resistance. I'm actually going to be talking a little bit about that on the educational part of today's show.
Yeah, and you're going to be getting into the psychology of a bear market. We're looking forward to that.
It's overhead supply. It's, I bought before, but now if I get back to that level, let me get out and break even. And that's the kind of sentiment we're going to start to see build into markets right now.
We just very quickly, Larry, we look for so-called havens or things that won't be as vulnerable to the trade war, but is just about everything under threat right now?
Well, what happened last week was the volatility in interest rate markets. Normally your bonds are safe, and we saw bond yields in the long end, blow out in a big way, and that was one of the big catalysts for the Trump administration to kick the can down the road on tariffs, because the funding markets were starting to get gummed up a little bit. And so that becomes a big problem. So where do you run for safety if interest rates are rising, if we're worried about inflation? There's not a lot of safe havens.
No, maybe we
Gold has been one of them.
Right, gold hitting record highs, of course, Friday. Maybe we can put up a 1-week chart for the US 10-year bond yield, because I'm just curious to see. There was a little bit of relief on Friday during the day anyway, but yeah, apparently that caught Trump's attention, the sell-off in US bonds. And there's the yield. So there's some buying going on right now, it seems.
Well, yields have come down a little bit today from where they had peaked out last week. This is more acute on the long bonds. If you look, this 10 years a long bond, but 30 years is the longest. And we saw actually the 20-year bond, or the off-the-run bonds, hit 5%, over 5% last week. So those are nosebleed levels. I love them up there. I think they're a great buy. And we were actually out there last week at those yields nibbling.
Okay. We are looking forward to your phone calls and emails with questions for Larry. And remember the topic, ETFs and large cap stocks, 1-855-326-6266, or email Berman's call at bnnbloomberg.ca. Email from Tom. My advisor urges caution on private equity, citing increased competition from new entrants, record dry powder, elevated buyout multiples, combined with the cost of leverage and the risk that depresses future returns. What do you think?
I think that comment's very naive by that advisor. When you look at the S&P 500, there isn't a company in the S&P 500 that doesn't use leverage. A lot of advisors, I would say that don't understand the private markets well, or don't have access to the private markets to sell it or to provide it to clients in an efficient way, will speak out against it because it's a risk of losing that client. And so I think that's a very real thing. Maybe the case here, I have no idea. Private markets are no different than public markets in the use of leverage, in the use of multiple, like there's multiples high or low. So anything like that, I think, is a very, very naive comment. But private markets are illiquid, and that is the biggest distinguishing factor. So if you as an investor need something that you want to be able to trade all the time, then private markets aren't for you. If you understand the benefits of earning that illiquidity premium by allocating percentage of your portfolio to private markets, then you should be in it. 90% of the investing universe in the world is in private securities, not public markets. And any advisor who doesn't understand that basic fact is not up the curve in terms of how private equity and private credit should be incorporated into portfolios. And pension funds have been doing this for Canadians, for people all around the world for years and decades in many cases. And I think the investment markets are way behind for individuals, and that needs to change going forward.
What about the publicly traded private equity firms, so the KKR or some of the Onyxes?
Again, that is public market experience for the investor in terms of volatility. That is not exposure to their private investment securities. That's an exposure to the profitability of that firm executing private equity and private credit, but it's not exposure to their private equity and private credit funds. Very, very, very different.
Okay. Grant is calling from Edmonton. Go ahead, Grant.
Well, good morning, Larry and Andrew.
Hi
How
there.
are you both doing today?
Very good. Thank you.
Well, good. It's great to see you again, Larry. I follow you regularly, and you and I have met personally a couple of times when you've done some advisor roadshows out in Edmonton. So, Larry, my question is that I've basically been waiting since 2008 in gold equities, gold and silver equities. Took the run up in 2011. Didn't totally understand and didn't get out, and now I'm basically fairly heavily invested in gold and silver equities. So I've got a plethora on my balance sheet. And the one I'm curious about is USA gold and silver.
Okay.
And if you could provide some comments on that, as well as when we look at some of these.
Well, let's keep it moving here because we are running out of time. America's gold and silver, Larry, or gold generally.
Yeah, so junior speculative. It's a company that's not profitable. I would argue that at gold and silver prices at the levels we are today, if a company's not profitable, you've got to ask why. I don't know this company well at all. In fact, having been whispered in my ear, there's a question coming on it. I just quickly looked it up, and probably will be the first time I've ever looked at this company. So I don't typically play penny stocks. I certainly don't play penny stocks in the junior mining area. I learned my lesson 35 years ago, literally almost cost me my marriage, speculating in junior mining companies, from an analyst at the firm I worked for that knew for sure it was going to be the best.
Right.
So I don't think it's a very challenging asset class. Now, what I can tell you about gold and mining stocks right now, I think gold prices are going higher. I've said recently they're overbought. They're getting more overbought. I want to buy into weakness. But the costs, from my understanding, are rising at a faster clip than the revenues for a lot of mining companies. And that's why their valuations are remaining relatively depressed to where the price of the underlying commodities are today. But I would defer that question to someone who's much better in terms of the fundamentals of the sector than I am. I've got exposure. I like it. I'm buying dips. I think it's going higher, but I don't know much at all about USA. And when I looked at it, it's not a profitable company.
No, it lost money last year and in 2023, adjusted earnings, both periods. Andreas is in Calgary. Go ahead, please.
Hello, I'd like to ask a question to Larry Berman about Cleveland Cliffs and the iron ore sector, because I know a lot of commodities seem to be in a little bit of a trough right now, and I'm hoping. I just want to know his opinion about it. What's his opinion about the company? Does he think it's good, or is it a thumbs up or a thumbs down? I'm just going to hang up and listen to what you have to say. Thank you very much, and thank you for taking my call.
You know, if you're in a trade war and the world is slowing, commodity stocks in terms of precious metals, steel-oriented, probably get weaker. So that's the period we're in now. And it's probably a buy sometime soon when we start thinking about the recovery on the other end of this. Probably a little bit too early to dip your toe in the water here, but this is a pretty good company, and this would be one to play at some point. But I don't think we're there yet, so I don't have a position in it.
Okay, no problem. We've got Graham in Medicine Hat, Alberta. Go ahead, Graham, please.
Hello. Just given the fact that bonds tend to be misbehaving of late, Trump tariffs and whatnot, your thoughts on X Grow or Z Grow? Would you get in right now, or do you think that they may take a pretty big hit? Thank you.
So these are BMO fixed income and equity ETFs?
BMO and iShare. They're balanced funds, but growth oriented. So it's 80% equities, 20% fixed income.
Okay.
And so they're great for the average investor. And how I've recommended using these, when you're bullish on the outlook for equities relative to bonds, then you want a V grow, a Z grow, an X grow that gives you more equities relative to bonds. And when you're defensive, you go into the balanced or conservative version that still gives you the balanced mix, but it's 60-40 or 40-60. Right now, I think it's way too early to be bullish on equities. Some point in the next 6 months, again, below 5,000 ballpark on the S&P 500, maybe below 4,500, I don't know. But at some point, absolutely much more growth oriented. Now is not the time.
Okay. Thanks for that question. We have an email here from Bonnie. I'm wondering what your opinion is on the TSE Bank Evolved Canadian Dollar Banks and Lifecos enhanced yield. I'm not sure what the symbol is on that one, Larry.
BANK.
Thank you. Well, that's easy to remember. Thanks.
Yeah.
Okay, go ahead.
So that ETF owns the Lifecos and the banks with an option overlay to enhance the income or yield. And that's the principle of it. So iShares, I believe, has a CEW that's an equal weight Lifecos and banks ETF. And so I would compare the two of those two in terms of what you're looking for. So if you want more income out of your portfolio and you're cautious on the market, then a BANK is probably going to do better than a CEW. This applies for all options yield enhanced products. If you're defensive to neutral on the outlook, then the covered call overlay is going to add some value to your portfolio. If you're bullish on the underlying, just buy the exposure you're looking for, equal weight, market cap weight, I'm indifferent to, generally speaking, and a CEW would do better. So it's a fine product. Evolve's come out with a lot of enhanced income-based ETFs. There's nothing wrong with them at all. At this point, I'd be more inclined to be a bit more defensive if you want exposure to the sector, which you would get with a covered call. But if the markets go down rapidly, there's no protection, right? You get a little bit extra yield, but you're really not getting any protection. It's all about path of returns in terms of how we get from here to there. But the covered call option strategy, a little bit more yield, a little bit more defensive, a lot less growth in the long run if you're bullish.
Okay, we'll squeeze in one more email from Randy. You suggested it might be time to buy into our favorite funds. I'm not sure what he's getting at there. With Trump in charge, are there specific areas you'd recommend? Tech, USA, banks, oil and gas, etc.?
Well, you got to love tech and technology in the long run. And I mentioned that, put it on your front burner. I said for the traders, you could buy it last week, and we've had a great rally. But right here, I don't like it. I think we're very overbought in a very short term, but that's what happens when the volatility level is as high as it is now. So I don't think there's a whole lot more upside in the context of the next 3 to 6 months. We want to buy dips. Technology is where, if you're a growth investor thinking about years ahead, is where you want to ultimately look for.
But wait till they get a bit cheaper, you would say.
Listen, at this current valuation still, not cheap. Cheaper than they were a few months ago. They're not cheap yet.
Okay, coming up.
We'll get another opportunity.
We'll get Larry's educational segment right after this.
Berman is one of Canada's top technical analysts. He's the Chief Investment Officer of ETF Capital Management. To learn more, visit etfcm.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN, its parent company, or affiliates.
Let's get to Larry's educational segment. Take it away, Larry.
We have one chart today, and I want to talk about the psychology of a bear market, because there's some of the indicators out there. Some of the economic forecasters are all saying, like, the economy's slowing. We got to start to worry. So here's the chart, and it's really the U.S. S&P 500 since the U.S. election. So here's the U.S. election. There's the big gap up. We celebrated levels. We held that election level. And then as President Trump started rattling the tariff sword, and gave the U.S. liberty on April 2nd, I would argue that it's not liberty yet. It may very well be a year or 2 or 3 from now, but it's not there yet, and for a while it's going to be uncertain. So if we've entered a bear market, there's a lot of ways to define it in terms of peaks to trough kind of moves, but by the time you're down 20%, we officially call it a bear market. Okay, so where did we come from? Well, 6,100 down to 4,835. Do the 20%. Okay, so technically we're in a bear market. What happens in a bear market? You make lower lows and lower highs for some period of time. The rising 200-day average begins to roll over. We're starting to see that with the green line there. The 50-day average starts to roll over. It will break below the 200-day average this week, officially defining a longer-term change in momentum. So in a bear market, we typically will fail at resistance. The biggest resistance right now, the 50% retracement of the rally, right around 5,500, which happens to be the old low that we made in March, which happens to be where the market opened on April 3rd as we gap down there, which happens to be where the market had the super rally and failed on April 9th. And so this 5,500 area is going to be big resistance. In a few months, that 200-day average will start to roll over into that area. Now, theoretically, we could go a little higher. There's now this falling trend line that in the next few weeks will bump up into this 5,500 area. So if I'm wrong and this isn't a bear market and this was just all noise, the market should be able to get above 5,500 and keep going. Okay? So that's the test in the next few weeks. I don't think it will happen. I could be wrong. But if we are in a bear market, what will almost certainly happen is we will retest this low at some point and likely go lower. How long would it take? You can extend these things out for quarters or months. I believe we need to see the economic decay that a recession would bring that would move the Fed into aggressively starting to cut interest rates and not worried about inflation. Andy, that's a couple of quarters at least from here. So more than likely for the next quarter or two, we're going to be in this trading range. Volatility is going to be high. It's going to be two-way, but don't look for it to break to the upside. If it breaks to the upside, Trump wins. This is all good, a new bull market starting. I wouldn't make that bet today.
Right. Yeah.
Because when you look at valuation, if in a standard recession, earnings fall 11%, you got about $245 in earnings already in the bank that the S&P earns. The go-forward earnings for strategists think earnings growth of about 8 to 10% this year. I think that's out to lunch. All the analysts that made their changes post-April 2nd brought their targets down to no earnings growth for the year. If we get a recession, we have a 20 multiple times 225 in earnings, which would be the standard recession. You have 4,500 or lower on the S&P.
Larry, thanks very much. We're out of time on Berman's call. The close is up next.